Hello, hello, hello. Welcome. Gonna try and get a few more people in here before we get started. Hopefully everyone received the worksheet and guide that I sent out.
Hello.
Okay, it is 7:02, so I'm going to go ahead and get started, and I will let people in as they start to trickle in here. I know a lot of people are going to be watching this video recording a little later, so I want to respect people's time because it is after dinner in the evening. So welcome to the first of a series, 7-part series on Capital Conversations, Masterclasses, hosted by Darshan Speaks. I'm Darshan Kendrick. And Darshan Speaks is a company that I founded, and we work with growing companies in order to accelerate their business growth by helping them meet specific business objectives and to prepare them to raise capital in the next 12 months. So we offer business consulting, business coaching, as well as speaking engagements. So welcome. A little bit about me. If you do not know, I spent the last 15 years as a corporate securities attorney with a law firm, raising billions of dollars in private investment funds from investors for my clients. And we have raised billions nationwide and helped them save millions of dollars in unnecessary court costs and fees as corporate attorneys. So that is what I've done for the last 15 years, helping companies all over the nation raise private investment capital. So I want to start off with a story before we get into sort of the first of this mini course, which is I had a client a few years back that came and gave me a document. And the document essentially said, I am giving $20,000 to you, my brother-in-law, in order to start a business. There were not any terms about payback, nothing about equity in the business. Just, I am giving you, brother, $20,000 essentially because I love you, because you're my brother-in-law, and I want to help you start this business. And one of the things I had to caution the client is that because the document lacked all sorts of terms and provisions, but because it was so vague as to if the client actually expected a return from that $20,000, there is a high probability that a fact finder, either a court or a jury or a judge, would find that that was in fact a gift and not an investment. So that is what we're going to be talking about today, is what is the exact meaning of an investment. So if this is the first time that you heard of me or of Darshan Speaks, you know that I am very, very passionate about education, and this mini course is meant to be the first of many exciting courses that we're going to have, including guest speakers and workshops on this issue. So let's get into what exactly is an investment. It is the foundation for the rest of the courses, so that's why I wanted to start off with this mini course. What is an investment? So save any questions that you have to the end, and you can follow along in the guide that I provided so that you can have a written guide by the end of this. So I hope that you will take advantage of that and you will get any questions prepared that you have at the end. So what is an investment? So this is the textbook definition of an investment, and I'll narrow it down once I finish speaking. So an investment is an asset or an item acquired with the goal of generating income or appreciation once you sell that item or asset. Appreciation refers to an increase in the value of an asset over time. when an individual purchases a good as an investment, the intent is not to consume the good, but rather to use it in the future to create wealth. So if you are buying something like a watch, I know there are people who invest in watches because of the type of watch, it appreciates in value. But if you're going just to buy a normal watch, because you are using that watch on a daily basis and consuming that as a product, that is usually not considered an investment. Whereby, for example, if you're purchasing real estate, you expect that real estate to appreciate, to have some income coming in, to generate wealth, and that you will, when you sell it, it actually is worth more than when you bought it. So an asset really is with the goal of generating income and appreciation. Going back to my example about my client that loaned or gave $20,000 to his brother-in-law to open up his accounting business, it seemed from the document and from speaking with the client that they had no expectation of generating income. They were just giving the $20,000 to the brother-in-law as sort of a love gift. So it is very hard to claim that you need a return on some money that you gave when the language of the document and all the things surrounding that document point to the fact that you are not expecting a return from that money that was given. So really the key words you need to focus in on is something is an investment if you have an expectation of generating income or appreciation. Okay, so next I want to go over the Howey test. And the reason this is so important, you're probably like, what is the Howey test and why is it important? Is because the 7-week course is going to focus on investments and securities. First, we have to figure out if something is an investment, and I've already went over that. The next thing is we have to figure out if it's a security, and a security has a very specific meaning. It's a lot of examples. I won't have enough time doing this mini course in order to go over those examples, but securities and investment in securities are regulated by the Securities and Exchange Commission, which is the work that I've done for the last 15 years. So it's important that we have a foundation of figuring out if something is an investment, and then figuring out if the investment is in a security so that it will be under the jurisdiction of the Securities and Exchange Commission, and all the rest of the classes will make sense. So let's go over the Howey test. So the Howey test, to make a long story short, is a Supreme Court case in which somebody was investing in a plot of orange groves, I believe down in Florida. And so the big issue was this an investment in sort of a joint project or land, or was it an investment in a security? And this is what the court ended up holding. So the Howey test has four elements that you have to meet in order to see if something is a security. Remember, you need an investment in a security in order for the Securities and Exchange Commission to have jurisdiction over what it is that you're doing, and really is the basis for what we're talking about during this 2nd-week course. So what is a security under the Howey test? The first one is that a transaction is a security if it's an investment of money. So that's one. And you may have heard about all the Bitcoin noise that's going around, because Bitcoin, is it fungible? Is it currency? What is it? So number one, it has to be an investment of money. Two, it has to be in a common enterprise. And essentially what that means is something that collectively people are working to provide that appreciation and that generating income, that there's a group of people that want to do it. So it has to be an investment of money in a common enterprise. Three, with the expectation of a profit. That really goes back to what we talked about, the definition of an investment. You have to have an expectation of a profit. If you're not expecting a profit, we call that a gift. Okay, so an investment of money in a common enterprise with the expectation of a profit. And four, it has to be derived from the efforts of others. And there's different layers to what that means, but essentially what it means is you are not doing the work in order to produce the appreciation or to produce the generating income. So for example, if I buy a house and I am fixing it up. In the general scheme of things, you might think, okay, well, there's an investment into the house because I want to invest in the house and I want to eventually sell this house for a profit. But it's those efforts aren't derived from others, they're derived from you. So technically, under the definition of the Howey test, that would not be a security, something that you would need to register with the SEC because it's coming from your own efforts, not from the efforts of others. It's coming from your effort. So to repeat, the Howey test, in order to determine if something is a security and under the jurisdiction of the Securities and Exchange Commission, which is what we're going to be talking about for the 7-week course. We're not talking about any other type of instrument. We're talking about investment in securities. It has to be an investment of money in a common enterprise with the expectation of a profit and be derived from the efforts of others. So we have the investment, we have the securities. In order for the Securities and Exchange Commission to have jurisdiction over both, you need 1, something to be an investment, and 2, for it to be in a security. So hopefully you're following along on your workshop and you have gotten all that. Now, I'm going to repeat again, why does it matter if something is an investment and a security? Not either or, but you have to have an investment and in a security. It's because the Securities and Exchange Commission, which was formed in 1934 as a result of the Great Depression, it is the federal agency that is responsible for investor protection. So any company that is raising capital will have to eventually deal with the Securities and Exchange Commission. But the only reason that you would have to deal with the Securities and Exchange Commission is if you have an investment in a security. So if you don't have an investment in a security, then they don't have jurisdiction. If you have one and not the other, they don't have jurisdiction. And essentially what that means is their rules and regulations don't apply to you, okay? So that's why it's really, really important that we have an investment in a security. Now, if you have an investment in a security, the Securities and Exchange Commission rules and regulations apply to you. No if, no ands, no buts. There are 2 ways to raise capital, which is an investment in a security. And that is going through the SEC, either registering or finding an exemption. So that's why it's so important for you to realize if you have an investment in a security. Because if so, then the Securities and Exchange Commission is the agency that you're going to want to stay close to and to follow the rules and regulations set up by the Securities and Exchange Commission, as well as any state laws as well. Whenever you're raising capital, remember you're talking about 2 tiers. You're talking about the Securities and Exchange Commission and usually about state law. So there's always 2 tiers when you're talking about raising capital, when you have an investment that you're looking for in a security. Okay, so hopefully I made that very, very clear. There's no if, no ands, no buts. If you're asking for an investment in a security, then you have to comply with the Securities and Exchange Commission's rules and regulations. Okay, so I'm briefly going to go over something that we're going to talk about a little bit more in the next class that we're going to have next Wednesday. So remember, these classes are Wednesdays at 7 p.m. We're going to talk about the types of investment, debt versus equity. Okay, so debt, I think everybody knows the definition of debt is a loan, like when you go to a bank and you ask for a loan. For many of you that have SBA loans, next week we're going to have a special guest from the SBA who is going to talk about SBA loans. But usually you can tell something is debt is if it has fixed terms of the amount that you pay back and a fixed amount of the payback period. So, $10,000 a month for the next 30 years, right? Something very concrete. Equity is less guaranteed. So all equity is ownership in a company. So that contrasts with loans, whereas you go to a bank or a community union to get money, they're not taking an equity in your company. They're just giving you, loaning you money in which you have to pay back at a certain interest rate, at a certain period of time, a certain period, monthly or quarterly, or however they do it. With equity, you are not paying back a certain amount monthly with guaranteed terms, and the payback has to be done within a certain time period. It is equity a percentage of the company, so you do have ownership. And usually when you take ownership in a company, you're not paid until that company makes an exit. We call it exit. Either they merge with another company and get bought out, or they do an initial public offering, an IPO, where they're listed on a public exchange, or something to that effect, where there is a time period in which there is an influx of cash that is coming in, and based on your equity stake, your percentage stake in that company, you get paid that percentage. So if you started out with 10% equity or ownership in a company, if it gets sold for $1 million, then you get 10% of that $1 million. I mean, that's the rough math. So you'll get $100,000. So debt has very fixed terms, okay? And there is no ownership involved. With equity, there is ownership involved, and it's less loose about when you're going to get that money back. Now, we'll mention there are hybrids of debt and equity, and we'll get more into that later in the 7-week course, such as convertible notes. Or convertible debt notes, where something starts out as debt, so it starts out looking like a loan, but the end goal is to convert it over to equity. So I'm not going to go into that because we'll have a whole mini course on that. And next week, we're going to go more into detail as to types of debt and the options that you have as far as loans, particularly SBA loans, with our special guest. So hopefully you will come back and tune in. For those of you that are looking at this video sort of on demand, that you'll sign up to attend this 7-week course. They're not very long at all, because it's meant just to give you a glimpse into how you can become investor ready. So hopefully you thought this was helpful. We try to be as helpful as we can and really guide you through the capital raising process. So I hope that you tune in next week, next Wednesday at 7 p.m., June the 28th, as we talk more and get more into the details about debt and equity. Okay, well, that is my mini course on what is an investment. So if you like this, share this, subscribe to, I'm going to put it on YouTube, subscribe to my YouTube channel, share it far and wide, and just continue to come back and ask questions in the chat or in the comment section, and I'll be happy to answer as many as I can. But of course, we do have consultations and our signature Investor Ready program, where we go through either 30 days up to a year to make sure you are ready to raise your first dollar as soon as you open your mouth. So we have a system that we get all your documents and pitches and your team and all that ready, so that you are investor ready before you even raise your first dollar. So check us out in the comments below, and I hope that you will join us next week, and that you will schedule some time just to chat with us about how we can help you with your business objectives and prepare you to raise investor capital in the next 12 months. So I am going to stop and see if there are any questions. We have a light crowd today, but I do want to be able to answer any questions that you have. Just remember, if you have any questions, to not ask anything confidential, because this will be posted on YouTube and other social media channels. So we just want to make sure that we protect your information. So if anybody has a question, then you can unmute yourself and ask a question. Okay, so if nobody has any questions, and feel free to unmute yourself if you come up with a question before we end, but let me go over a few announcements. This is our first class, obviously, so I am hoping that we get even more people to get this great free information as we go along, but you are going to receive a survey. So if you can complete that survey, I would appreciate it, because it helps us be better. If you tell us what else you would like us to do a masterclass on, or what we can do better towards this class. For those of you that receive the text messages, if you want to request a badge, just reply back to the number a letter R, and you will receive your badge for completing this class. So remember, in a follow-up email, you're going to get a copy of this recording. The guide is going to be attached again, and you are going to get a survey. And please, please invite people to these mini courses. It's free for my email list subscribers. So if you know of anybody that could benefit from this, please invite them to these classes. But if nobody has any more questions, I just hope everybody has a great rest of the evening, and that we see you back here again next Wednesday, June the 28th, as we talk more about debt and equity with our special guest from the SBA, Jeff Patterson. So everyone have a good night.